Welcome back, ladies and gentlemen. My name is Joshua Castillo. If you haven't seen me here on this channel, you've never seen my face before or anything like that, I am a value investor. I really like looking into companies. I like following other value investors. I also like learning a lot. So that's kind of why I use this channel. I use it as like a way of like keeping a diary of things that have happened, whether I'm buying companies, selling companies, looking into things, or just looking into people. I want to kind of use this as a platform, as a way for other people to be able to kind of bounce ideas off each other. And that's kind of the whole intention of this. Now, as you saw from the video, I'm going to be taking a look at 4 stocks that I think are worth taking a deeper dive into if you are interested. So that's kind of, I'm going to give you guys a brief overview, and then I'm just going to, kind of go over why I think there might be something there. But again, none of this is financial advice. I do own some of the companies in this video today, and I'll mention them as I kind of get through them. But with that being said, let's hop right over to the computer and go through the slideshow that I have, and let's dive right into this. All right, so 4 stocks to research in September 2023. And really where this all comes down to is, where the price has gone. So the 4 stocks are going to be Revolve Group, PayPal, BJ's Wholesale Club, and Ulta. Now, it's not going to be in that order, unfortunately, but the reason that this happened the way it did is just how it listed. But what I really wanted to focus on is look how far down they are year to date. So Revolve Group's down 33%, PayPal's down 14%, Ulta's down 11%, and BJ's is down 3%. BJ's is probably the most simple one out of all of them. So you'll see in the business as to why it's not down as much this year. But as far as like a year long, some of these companies were way higher given, a year or two ago. So they're substantially down if you go look at it on a multi-year basis, but year to date, here is the number. So diving right into the first company is PayPal. Now, just a warning, disclaimer, whatever you want to call it, I own a call option in PayPal. When I do my portfolio review, I'll kind of talk more on it, but I bought a call with a strike price of $60. So if that's in case where my interest lies in looking at this company, this is partially why. Now, what their business model is essentially they handle the payment solutions for the consumer and they handle the payment solutions for merchants. So if you're running a business, selling something on eBay, you're going to go purchase something online, oftentimes you're purchasing using one of PayPal's products. Now, when you look at something like a Visa or MasterCard or American Express, they control the credit card and what they use. So they take a fee off of that credit card every time you use that credit card. Versus in this case, if you're sending money, receiving money, if you're using PayPal's kind of, network basically, you're going to be paying a fee to them, or the merchant will be paying a fee to them. It all depends on what you do. But you can see that they have different checkouts, they have processing, they have digital wallets, and they have merchant services. So again, across all the different products, they really have a two-way street where they control a lot of what you see. And Venmo and PayPal are some of the biggest kind of digital wallets or digital services that we have on our phones and on our computers today. Now, as far as their business model goes and what they've done, I believe I pulled this from the most recent quarterly investor presentation. So basically, as I mentioned earlier, two-sided network, and it's growing at scale. And one of the things is they have 400 active consumer accounts, 35 million active merchant accounts, $1.4 trillion in total payment volume, and 24 billion payment transactions. And their reach is basically 200 global markets, 150 to send currencies, and 25 to hold currencies. And again, the reason that they have scale, reach, and trust is one of the big things, because when it comes to financial institutions, when it comes to moving money, trust is probably the biggest thing out of anything else that the financial institution can have. Trust is probably the hugest thing, because as soon as a finance company or financial solution or bank or whatever loses trust, all of a sudden everything else goes downhill really, really rapidly. So that's kind of why they mentioned it there. I figured it was kind of interesting. Now, as far as what they've been doing with their cash, this goes back to 2016. Again, this is from their investor presentation. So if you go look back at it, they're trying to give you the highlights of the business. And I'm not going to go into any of like the weaknesses or things there. I just might mention it offhand, but there's nothing specifically I'm going to go into. But as far as capital allocation and what they're doing, you can see that a few years ago, a lot of their capital allocation was going towards acquisitions and investments. And these days, it's growing into more of the share repurchases as well as investing into CapEx. So basically what they've been doing is they've been buying back stock. And Honestly, it would work a lot better if they weren't giving out so much stock as restricted units to their employees. Now, again, it's kind of a push and pull. They have to give out stock to keep employees, but they also, it's not to the benefit of the shareholder if they're spending $5 billion on stock buybacks and it's not really moving that much. But you can see over the last 12 months, they've spent around $5 billion in stock buybacks. Their market cap as today is basically $70 billion. So, they're buying back a significant amount of their market cap, but again, they're issuing a lot through their restricted units. Now, what I see as kind of a catalyst, now PayPal feels to me like a little bit more expensive than what Meta was back in October of last year. But as far as sentiment and things like that goes, I feel like PayPal has that sort of bad sentiment around it. So that's why I think number one, just a simple reevaluation. If someone catches this, or when the new CEO comes in, as I mentioned as number two, things can change rapidly and that sentiment can move. And that's really what's going to make people a lot of money, is just the sentiment changing around PayPal. You saw that with Meta. It went from $80 to $325 as of the most recently quarter earnings. I think it backed off that a little bit. But to have that kind of run up in under a year is kind of crazy. But the new CEO is coming from Intuit. It's Alex Chris. I'm excited to see what he ends up doing. There's really not too much on him as of right now. A big piece of it, him stepping in, is going to be relieving basically the old CEO who announced his departure, or he's going to be departing at the end of the year, but he announced it at the beginning of this year back in February. So it'll be interesting to see having someone come in, especially because he's coming from Intuit, coming in, someone that's worked with small, medium-sized businesses, to see if he does anything different, does any sort of reinvigorating on, as far as their business and monetizing things. So I'm excited to see that. The third one is they are actually selling some European pay later receivables. So that'll net them about $1.8 billion on closing. That'll be interesting. I believe it was part of a KKR deal, if I remember correctly. And then number four was the stablecoin business. Now, I wanted to pull up a tweet real quick. If you don't follow me, my Twitter handle is investwithjosh_. But really what I wanted to pull up was the stablecoin, because it was something that I was looking into recently as I was kind of doing my DD on, PayPal. And this is one of those things where I think that this is on track. I don't know how right or wrong it's going to end up being, and I'm just going to go through it really quickly, but it's basically a tweet from Derek Quick One, and he has kind of an explanation as to what will happen. So you can kind of see the stablecoin is projected to grow about 2,200% to $2.8 trillion in the next 5 years. I don't necessarily agree with crypto and all that stuff, but I think that stablecoins will be something that a lot of people will end up using in the future, as well as PayPal has crypto services beyond stablecoins. So that's part of it too. But you can see here kind of the global payment network transfer values and what they're estimating, as well as just different things that are moving. So you can see PayPal down here along with MasterCard, Visa, and the stablecoins right here, and you can see Bitcoin up there. Now, the stablecoin volume outpaced MasterCard already, and you can see that here. So look at the transaction volume, look at the number of transactions. So again, PayPal's at 1.4 trillion, stablecoins at 11 trillion, and then you can see how many number of transactions have happened. So again, when you kind of have, stablecoins coming in as a thing, and PayPal's going to step in and kind of make try to make this something that's key to their business, I think they'll benefit for it, especially because if you look down here, they have a lot of active customers. So as of 2022, 435 million. They've been growing at about a 15% CAGR, which is really, really good. But again, you'll have to see how this ends up playing out. But I think that just having the stable coins and getting to mint basically off of that and get some of the gas fees that kind of come with that, or just holding it and getting the interest on it, will be something that I'm curious to see more about. But that to me is just one of those new technology things where you don't know how it's going to work out yet. So when I'm looking at this, I'm looking strictly at like the business level of the PayPal, what's there currently, and then kind of taking a look at what are the opportunities that might be there. PayPal's valuation. So if you look just, I pulled this from ticker.com. All the other numbers are going to be pulled from ticker as well. But basically the next 12 months, that means, the next 4 quarters, is basically a 11.99 times PE, 10.21 times price to free cash flow, and it's yielding you almost 10% on your free cash flow yield, which to see that, it's something that a lot of people like, as well as you can see that the last couple of quarters, what has happened is it's slowly gone up and up and up. And as you've seen, the price of the company went down this year, and it's also gone down. I think it topped out around 300 $300 a share or something like that. To have it at $65 pretty much now is kind of crazy. And then down here is the last 12 months. I'm not going to dive into that too much, but you can kind of see where they're at now, last 12 months, and what they're kind of doing there. Now, as far as their valuation goes, I think that if they can keep up this kind of, ramp up in EPS, and as far as what they've been doing, you can kind of see where they're at now. So let me pull out a little calculator. So right now, price $63. Divide that by 2024's EPS. It's selling at 11 times basically, and that's kind of what you saw in the last piece too. So if the thing is, it's like one of those things, like if the multiple is right and it's gonna be 11 times earnings, I mean, you're gonna basically stay where you're at now. And let's say if it goes back to sort of the mean, which I think was around like 15 or 20. So rather than, having sort of a 11 times multiple, let's say you just go back to 15. That's an $85 basically company. So for me, it's one of those things where, after the due diligence, after looking at the valuations, and I did run a DCF on this, but after looking at everything, I think that there is some upside here as well as some downside protection. But again, you're going to have to see how this new CEO, when he comes in, what the philosophy is, what the board wants. But I think that they've been searching for a while, so I wouldn't be surprised to see if that the new CEO was pretty much picked or, kind of sought after by the old CEO and the board that has kind of ran this company for quite a while. Now, Ulta Beauty, this is another one of those companies that, it's a really simple company to understand. As I mentioned earlier, it's a makeup company. They sell makeup, they sell cosmetics, they sell hair care, skin care, anything that you could possibly think of as far as like personal hygiene, personal care, anything like that. It's going to come from Ulta. And the best thing ever is that cosmetics has continued to run this entire year. It's continued to run through last year. And in a lot of cases, people are going to wear makeup. If there's an up market, if there's a down market, if there's recession, no recession, people are going to wear makeup. What will end up happening is you have different kind of tranches of different companies. So MAC, Dior, Olaplex, Fenty Beauty, those are probably more expensive, more on the higher end side. So you'll probably see some weakness in that in terms of if there's a recession. But you have companies like e.l.f., CoverGirl, CeraVe, and Neutrogena that probably sell to the sort of middle to low end customer, as well as like college students and things like that. And a lot of this is brands have to get into marketing and get into target consumers and get into that stuff. Well, guess what? Ulta doesn't really have to do that for the brands. They just bring in brands that have a big target market or target audience, and the brands have to kind of do that. Now, they do have deals and partnerships and different things like that, but my fiance is actually works in the makeup industry specifically, so I see a lot of this stuff. I see a lot of the reactions. I see a lot of the people that watch her videos, and to me, we go to Ulta all of the time. So for me, I'm mad that I didn't pick this one up back when in 2020, and I kicked myself in the pants for it. But now I'm looking at this company again. The PE has dropped, and the valuation has kind of come down a little bit from the skyrocketing that we've seen. But man, the opportunity is there. So you can see as far as the market goes, $104 billion market. You can see what makes up this market. Again, if you're interested in like some of these brands are companies, like stock companies. So e.l.f. is one of those big ones, as well as you can get into some other companies as well that get sold through Ulta, and look into specific cosmetic companies if you're interested in that. But as far as what they sell basically hygiene, bottom to top, care, basically self-care. So when you get into this, you can see kind of what they have. So again, as far as what has come through, specialty beauty is one of the biggest channels. It's growing pretty large, and you can see kind of how it's broken up, and they sell in all of these categories, which is completely insane. So as far as what they're doing, they have Ulta Beauty stores. If you've ever seen one, they're all over the place. I live in Los Angeles, so I see them all the time, but they're all over the place. Ulta Beauty also partner with Target. You can go to Target, most Targets, and see that they have basically a giant section within Target to sell makeup, which I think is way better than what they used to have. They used to have like a, lower end, makeup kind of assortment. And I think that having Ulta there, because it's usually the first thing you see when you walk in. A lot of places, it's like its own entire section has a giant Ulta sign and all that, as well as you can get stuff online. But a lot of this is in person. So for companies like Target to bring in Ulta into their stores, you're driving a lot of foot traffic just into the Target store. And of course, Ulta's going to, pay a little bit to Target to be able to sell products, but having that is going to be very beneficial for both companies as well as Ulta when they have their own stores. Now, as far as the catalyst goes, honestly, I think, again, a simple reevaluation. I think it's selling at around 15, 16. Sells usually a little bit higher than that. So that will give you a little bit, going into the future. But I think that continued partnerships is going to be one of those big things. And I mean partnerships with bringing on brands into their stores, giving them opportunities. Because the thing is, if a brand goes huge and they offer it in Ulta, people are going to come shop at Ulta. So if you look at like an e.l.f. Beauty, that company has ran a ton. Their stock is up so much. But as a brand, they have grown a lot, and their following has grown a lot, and their products have grown a lot in stores like Ulta. Now, number 3, increase store count. As any retailer, increasing your store count is going to increase the amount of people that you can sell to, as well as digitally. So the last one is going to be share repurchases. And they basically have bought down their shares a lot. They've been repurchasing a lot of shares. Their shares as a total is down 17% from 2019. So that's pretty awesome to see them come down that far on their share repurchases in such a small amount of time. And again, that's partially why I think their stock has run up quite so much over the last couple of years. But again, if a company has nothing else that they can do that will return more than that, I think buying your shares back is going to make you quite a bit if you're an investor into this company. Valuation wise, again, 15 PE, 17 price to free cash flow. The free cash flow is around 5%. If you look down at the last 12 months, the diluted EPS and the price or the PE is 16.7, and the price of free cash flow is basically 25 to 30. So it's kind of fluctuated a little bit. You can see that the free cash flow yield has gone up and up and up. And I think that as they kind of leverage the stores that they currently have, as well as build out more stores, over time, you'll see this free cash flow continue to benefit them, and as well as continue to get capital allocated towards a shareholder, like buying stock and things like that. They don't have a dividend, so that'll be interesting to see in the future if this company really slows down as far as they don't think they can do anything else. They start offering a dividend, which is, I'm curious to see what they end up doing with that. But I really liked what I saw here on the numbers. Now, as far as the shareholder returns, as I mentioned, you can see here their operating cash flows has continued to go up, and they've continued to buy back more and more stock. And I wouldn't be surprised going into the future if they continue to benefit from this, if they'll just keep buying stock back, because you can see what they've been doing. It's just below their operating free cash flow or operating cash flow line. So to see that continue to happen, as well as the CapEx isn't really a lot, relatively speaking, compared to that free cash flow, or compared to that, operating cash, but really compared to that free cash flow, I'm curious to see what they end up doing. I would not be surprised in the future at some point if they start offering a dividend. Now, lastly, you can see their EPS growth. Now, the stock price as I'm making this video is $416. Again, pulling out the calculator, you can see that over time, this EPS has kind of normalized above 27. So, if we take 27, which is, again, this is the estimated EPS in 2025. So if you take the estimated EPS, divide that like that, you basically have 15 times company as far as their EPS goes. So if they continue to grow, they continue to buy back stock, that'll also push the EPS a little bit higher. So we'll see what ends up happening. But I think if I can get this company at a good price, I can make a lot of money over long term. And that's where I'm at. I don't own this company yet, but it's something that's on my watch list. It's something I've been keeping track of, and I'm hoping I can get it on some weakness in the near future, but we'll see. Next up is BJ's Wholesale Club. This was actually someone named The Patient Investor. Well, his channel name is The Patient Investor on YouTube, but he talked about this company as well as Ulta. So if you haven't, go check out his channel. But he basically talked about BJ's and talked about Ulta, and BJ's was the one that it kind of clicked for me, and so I went and did my own DD, went and did my own kind of research, and I need to put out a video for this because I kind of have been prepping it. I just haven't finished it completely, the writing of it completely. But basically what they do, it's like Costco, it's like Sam's Club. They sell product at a discount, but to get into the store, you need to buy a membership. But the thing is the way that they approach the market is different than Sam's Club and Costco. I think that's where they benefit. So for, where they do versus club, they have a smaller pack size, smaller club format, convenient locations, full service deli, as well as it's more so like a cheaper grocery store. So you can see there again, 25% lower prices. They have that treasure hunt experience, and they also offer services and fuel. So gasoline is not something that they're trying to make a ton of money off of, but it is something that they do benefit from, if gas prices go higher. So you'll see that on their earnings. They try to back it out a lot of times and kind of tell you, X gas or whatever like that. So you will see that. And then mass channel, they try to sell things below. From what I have seen, the biggest thing is look at this membership growth over, years. Look at how much that is compounded away. It's kind of insane. And they don't increase their membership that often. I mean, you can see there, it's 4 different times. They don't increase their membership that often. So to have that, along with the fact that if you listen to the call, if you listen to the investor presentation that happened towards the middle of this year, the whole call, the entire investor presentation is basically them saying, we're trying to find value. We're trying to find a way to make things cheaper as well as make money. But the thing is that they're leading with this. We need to provide value. That's how we build our customer base. That's how we get trust. That's how we get customers in the door, and that's how we retain customers. Their retention rate right now on their membership is 90%, which is insane to me. And they've grown that. I think it was like 86%, 85% back in 2018. To have that at 90% now, when people, recession is, whether it's on the horizon or not, people felt the inflation. That's something that had happened this year with this company. They felt it as well. So having inflation subside will be something that we'll have to see from the consumer perspective, how that benefits this company. But as far as their catalysts for the company, it's going to be increasing store count. They've been putting out, 10 to 11, 15 stores, somewhere in that range. Most stores tend to take a few years to kind of pay themselves back and then start producing for the company. So building out more stores. All the stores are located on the northeast side of the United States. And then growth in membership and price increases. They're not going to increase the price of their memberships that often, so I wouldn't expect that. But just growing the memberships through opening more stores or just getting people through the door is a big thing. Share repurchases, and then getting a higher mix of own brand penetration. So basically, rather than selling, whatever kind of brand that they have, giving themselves kind of a private label brand that maybe costs a little bit less, or it's costing on price of what the other stuff was, but it's better options or better opportunity for a consumer to get rather than, whatever the name brand thing is. So that's a higher mix as far as, their gross margin and things like that. So that's a big thing too that they've been pushing is their own brands. And they've kind of reduced how many brands they have in store as far as own brands go. They're not trying to tackle every single market, but a lot of the kind of grocery side and kind of more of the commodity side, they've been trying to get more value for the customer, which I think is great. Now, as far as evaluation goes, honestly, it's probably closer to fairly priced or underpriced than it is overpriced, because again, 16 price to free or 16 PE and a 23 price to free cash flow, 4.3% yield. It doesn't look great as far as evaluation if you're looking for a deep discount, but you have to remember, this is going to sell for a premium once everything starts kicking in. So it's really is it selling for, a price of free cash flow up 23 times today, or what is it happening in the future? So that's why this company is kind of a hard company to get comfortable with, because it kind of has the same issues that Costco has, where it's going to grow, it's going to do well, and people are going to find value in it. It's just how long are you willing to wait? And for me, if I could get this company a little bit cheaper and hold this for a long time, I'm going to be very, very, very happy. So you can see what they've been doing with their free cash flow and basically what they've been doing with their cash overall. So first things first, CapEx is going to be growing overall. As they open more stores, they're going to be putting more CapEx, obviously. So having free cash flow and that operating cash flow grow, as well as the net income grow, will be something that they'll need to focus on and make sure costs stay on track with what they need them to do. Now, they've reduced their debt almost completely. Their debt is really, really low relative to where it was pre filing of their IPO, 5-6 years ago. And then obviously you're going to see returning cash to shareholders. So they've been buying back stock. They're going to continue to buy back stock as their, net income and things like that kind of grow. So they're already repurchasing shares, and you can see in the last few years what they've been doing. So that's great to see as well. And part of it, again, if inflation kind of subsides and they're able to kind of, level out their business and not have to deal with 8-9% inflation, I think that they'll do well over the next coming years. Now, as far as their estimates go, I don't need to pull out a calculator for this, but basically they're going to be doing, relatively okay. Again, it's selling, if you take 65 divided by 4, it's pretty close to 15. So they're doing pretty okay as far as evaluation goes. If I can get it for a little bit cheaper, that would be awesome. More than likely what I've been looking for and kind of my target is around the $60 range, but that would be kind of the low for the year. I don't know if it's going to go down that low. So it may just be one of those things where I open a position, track it. If it drops lower, I'll continue to dollar cost average into it. So I'm not 100% decided on it. I'm still looking into a couple other things while I'm doing the write-up for the video. So I'll let you know once I do the video what I end up deciding on. And then lastly, the last company that I wanted to go over is a company that I do own. I own stock in this company as well as I sold a put on this company, is Revolve Group. Now, what Revolve does is they sell basically high-end fashion. They sell, like kind of the more, I don't know what you'd call it, on-trend kind of fashion. So it's a little bit more expensive. Their average order value is, upwards of $300. So to have that be kind of like their price point, you kind of get an idea of where we're at. Now, Revolve itself, they have two segments. They have Revolve and they have Forward. Revolve is kind of like the, I don't want to say middle income to high income, but more so like the middle income range where you can buy really nice clothes, but it's not going to break the bank like crazy. Versus Forward is definitely the high net worth individuals are buying stuff from there. It's a lot of really expensive clothes, really expensive brands. So if you're, baller, shot caller, you can buy on Forward. If not, you probably end up going to Revolve. And then for like the middle class people, it's probably not a ton of items from Revolve. It's probably only a couple. But you can see that overall they've benefited mostly from the US. They're growing into international and they want to expand that continually. They're trying to expand into China and Mexico right now, which will be exciting if they end up doing that. But you can see from a KPI standpoint what they've been doing. So the last 12 months is what you're looking at as far as their KPIs go. Their active customers was around 2.4 million, as well as their total orders placed was 2.2 million. And their average order value is around 301. Now, right now where they're at, they're dealing with a lot of the kind of pullback in spend from a lot of consumers, and consumers more so having to carefully allocate dollars to services versus product versus, all sorts of different things like groceries and things that they actually need to buy. So that's kind of what we're seeing from the business standpoint as far as Revolve goes. And when I show you the EPS and stuff like that, you'll see what I'm talking about. Now, as far as their catalyst, I think that they need to turn the ship around as far as like getting people to come in the door and buy product. I think that they can do that through continual growth in the international market. China has been a big piece of that. As far as, what they want to get into, I believe they were in the 6th, most popular brand on Temu, Temu back in, I think it was June or July. So that'll be exciting. Their share repurchases was recently announced. I think it's $100 million. And then partnership opportunities. So this brand benefits a lot from marketing, getting people in the door, as well as, getting new partnerships done with new creators to kind of open up their market more, get a bigger target audience. Kendall Jenner is the marketing director, I believe, or kind of the creative director for this brand. So having that as kind of like the person that speaks for your company and kind of is the visionary for the company helps with getting people in the door, because again, people kind of want to buy things thinking that they're an influencer, buy things from people that they're influenced by. So Revolve's valuation, you can see 26.69 as the PE for the next 12 months, and then the price of free cash flow is around 12. Their free cash flow yield is around 8.1%, and that free cash flow is kind of turning around right now because they don't have to spend as much on capex. So it'll be interesting to see kind of what happens as they've already kind of normalized their inventory and things like that, and they're not dealing with as much headwinds from the freight and logistics side of their business. Now they are still incurring costs and there's still pressure there, but it's not as significant as it was last year, which is why you see a difference between this year and last year. But you can see down below the last 12 months is 26 PE, and then pretty much around a 40 to 50, price of free cash flow. So there is some opportunity there, but I think that this one's probably getting more sorted down to like sort of the undervalued range as it keeps dropping, and not so much to the overvalued range. So we'll see though. Again, it relies a lot on their growth going forward, whether or not they're undervalued today. Now, as far as their free cash flow goes, you can see again in the first half of 2022, it dropped substantially from 21 and 2020. Not surprising, because they had to start spending on things, and as well as inflation was running amok last year. And then you can see their cash and cash equivalents is around $269 million. Now, this company doesn't have any debt, so basically all their assets is clear and free for the most part. They don't have any debt on their balance sheet, which is partially why I'm still comfortable with this company and what they're doing. But as far as their numbers go, so you can see the stock price is currently $14.85 as of making this video. Their estimated stock or EPS at the end of 2024, basically 69 cents. So pull out the trusty calculator, because I can't do this one in my head, and basically divide that by 69 cents. So it's selling for about a 21 PE right now. And the thing is, again, if they can grow their EPS substantially, which I think that they can, given the trajectory that they're on, a lot of it partially has to do with the consumer and what the consumer's belief is. It seems like for the most part, the consumer's kind of turning it around, but with student loan payments and things like that kind of coming in, that will impact going into the next year. They think on the call they've talked about, they think it's short-term headwinds, and they think it's more near-term than it is kind of a long-term cyclical thing, but we'll have to see. I think that overall retailers, as far as, you can see from this video, retailers are kind of getting dropped all over the place, so finding good retailers and finding people who are actually selling products that people want will be a big component of that. Now, that brings me to the end of my video. I hope you really enjoyed these companies. Let me know if you agree, disagree, found other companies that may or may not be undervalued that you think you want to look into more. But again, I'm not showing this as like these companies are undervalued and you should buy them now. I'm showing this as you need to look into these companies if you're interested in what I presented today, and they may present an opportunity that you think is interesting or spark something else. And that's kind of the idea. I don't care whether you buy these companies or not, because to me, you and I are both retail. I don't really care what you end up doing with your money, because it's your money. So, and I don't want to tell you what to buy, because that's not my job here, and I'm not a financial advisor. So that's partially why. And then the other part is I think that it's important to do your own due diligence. It's important to kind of get ideas from other people, but look at things yourself. Don't just buy because someone else says it's a buy, or undervalued or overvalued, or whatever you think it may be. So with that being said, though, thank you all for joining me today. I hope you really enjoyed the video. Thank you for watching, and have a great day and happy investing.